Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone for supporting the channel, all the viewers, all the subscribers. Immensely appreciate the support. For today's video, I thought I would go through all of the open options contracts in the portfolio. There's been a number of viewers on the channel wondering how involved have I been with options contracts, so I thought I would go through, detail all of the current options contracts that are open, as well as highlighting a few things regarding options. There's been a number of questions regarding collateral. There's also been a number of questions regarding if you keep the payment that is received on an options contract or you have to give that back, depending on if an options contract expires or is executed at the end of the period for the options contract. So I thought I'd go through all of those today. First, let's take a look at the portfolio. I've been talking a lot about covered calls, essentially selling contracts on stocks that you have in the portfolio. Again, you need 100 shares of a stock to sell a covered call, essentially one contract. Again, one contract is 100 shares. But on the other hand, you can also sell puts as well, essentially obligating yourself to buying a stock at a particular price. And instead of using stocks in the portfolio as collateral, you'd simply use your cash balance as collateral. And we'll kind of go through all of that to make this more clear. Let's first go through all of the contracts. First one on screen, as you can see here, is T $33 call 6-1. So what this is saying is that I am obligating myself to selling AT&T, ticker symbol T, for $33 on or before June 1st. So if the stock gets up to $33, I'll have to essentially sell the stock off to an investor. And what the other investor is looking for is that stock to get up to, for example, $40. They can buy it from me for $33 and then sell it to the open market at $40 to make a $7 profit. What I'm hoping is that the stock never gets up to $33. The options contract expires, and I keep the amount of funds that were dispersed to me for making that contract. As you can see here on the bottom, that same contract, $33 call sell 6-1, $49 as well as $33 call sell 6-1, $7. So it's essentially $56 overall for this particular contract. Again, I'm hoping that on June 1st the stock does not get up to $33. The contract simply expires and I keep my funds. If it does execute, I still keep that $56, but now I'll be obligated to sell off my stocks in the portfolio. And just to go down here a bit here, to highlight as well, stock collateral, 800 shares of AT&T. Again, each contract is 100 shares, so you can see it, -8 contracts. Again, that negative means that I sold off a contract, and the 800 shares there is held in the portfolio. I can't trade with that stock until I buy back these contracts, making that -8 a 0 again. Then I can trade, buy and sell stocks normally on the application here. Let's now go over to a put. You can see here, Portola PTLA $35 put 615. What this is saying is that I'm obligated to buy Portola at $35 a share on or before 615 if the stock gets down below $35. So essentially what an investor is looking to do is buy the stock for the $35 or more and then sell it off to me at $35 when the stock drops below that price. So it's kind of an insurance policy for the person buying this particular contract. If Portola, for example, went all the way down to 0, the other investor would not lose any money if they bought it for $35 because I would be obligated to buy that stock from them for $35 even though the open market price would be 0. So it's sort of an insurance policy for the other investor. You can see on the bottom of the screen, just like a covered call, that AT&T contract, I get reimbursed for making this contract. You can see $35 put sell 615, $25. And now you can see in the middle as collateral, it's cash collateral, $3,500. Again, 100 shares, $35 each share, $3,500. So if that stock, again, does dip below $35, the other investor could obligate me to buy their shares for $35 a share. Again, as an insurance policy if the stock does start trending down. The next one here, Ford, $9.87 put 921. Again, I'm obligated to buy Ford at $9.87 per share on or before 921 if the stock dips below 987. Again, the other investor has an insurance policy on Ford. if Ford, for example, went all the way down to 0, they would still not lose any less than $9.87 because I would have to buy that share from them for that particular price. Again, on the bottom here, you can see that I got a cash payment. Let's go all the way down here. Ford $12 call sell, 118.19. Ford $12 call sell, 118.19. Those were the covered calls I recently reviewed on a video. And if we go all the way down to the bottom of the portfolio here, you can see in the middle, Ford $9.87, put sell $9.21, $43. So I got $43 for making that particular trade. Again, I will always keep that money no matter if the contract expires or I am obligated to buy Ford at $9.87 per contract. Again, in the middle here, cash collateral, it's $987 for this particular trade. The other 5,400 shares of Ford were the other covered calls that you saw here. These two payments here, $12 call sell, 118, $12 call sell, 118, for reimbursements of $1,140 and $1,960. Those were the stock collateral, and the cash collateral was that put sell, $987. Again, 100 shares at $9.87 equals $987. That is now locked up in the portfolio. I cannot use either the shares of Ford as stock collateral for those covered calls to buy or sell Ford. I can actually buy Ford, but I can't buy Ford with this particular cash collateral, and I can't sell this Ford in the current portfolio, the 5,400 shares, because both the cash collateral as well as the stock collateral is locked up in these options contracts. The next one here is another covered call, IRM, $35 call, 1019. Again, just to reinforce this idea, I'm obligated to sell IRM, Iron Mountain, at $35 a share on or before 1019 if the stock does get up to or above $35. So again, the other investor is looking to buy it cheaper than the current market price at that time and then sell it to the open market to make a difference. So if IRM, for example, on 1019 was trading for $40 a share, the investor could essentially make me sell my shares to them for $35, and then they'd go around and sell that back to the market for $40, making $5 a share. Again, you can see here I have one contract, -1. That means I sold off the contract. Again, anytime there's a negative number there, that means you sold off a particular contract. Stock collateral for this particular trade, 100 shares of IRM. And if we go to the bottom here, you can see $35 call sell, 1019, $115 credit. Again, I always keep that credit no matter if this particular contract expires and nothing happens, or I'm obligated to sell IRM for $35 a share on or before 1019. A couple more here. We'll go through these in a little less detail. APLE, Apple Hospitality, one of my favorite real estate investment trusts. For this particular contract, I am obligating myself to sell APLE for $20 a share on or before 1/18/19. You can see I sold off two contracts. Again, -2 means I sold two contracts. You can see 200 shares of APLE as stock collateral. I can't sell those stocks off in the portfolio. I have to essentially buy these contracts back. You can see on the bottom here, I got a cash payment of $50 for making that particular options contract. Here's another Ford call sell, Ford $12 call sell, 1/18/19, and those were the two payments that I detailed earlier. The $1,140 payment as well as the $1,960 payment. And again, essentially the same screen as the other Ford put sell. Those 5,400 shares of Ford are the collateral for this particular covered call. So again, a covered call with Ford, a covered call with APLE, Apple Hospitality, a covered call with IRM, Iron Mountain, a put sell with Ford, a put sell with Portola PTLA, and another covered call with AT&T. So again, if we go to the bottom here, each of these cash payments, the $49 for AT&T here, for example, for Portola, the $25 for Ford, two different contracts, the covered sells here, $1,140, $1,960, as well as scrolling all the way to the bottom here, the put sell, $43. If we go back to the other contracts here, IRM, the $115 payment, APLE, the $50 payment, and again, that Ford contract again. Each of these particular payments in the portfolio are going to stay in the portfolio unless I sell off the options contract. So Again, no matter if the contract expires, nothing happens to it, it simply disappears. I keep the cash payment, or if I'm obligated to either sell off my stocks or buy stocks from another investor, I still keep that original cash payment. It does not change. The only way of not receiving the full payment for these, for example, let's say I wanted to sell off AT&T here. I wanted to buy back the contract. So a covered call, I sold off a contract, again, -8. I'd essentially have to buy those contracts back by buying this particular order. I could do that. The current market value would be $40. Again, I got reimbursement of $56 to $49 and $7. So you can see in the middle here, the total return would be $16. I'd make 28.57% of that original cash payment. So I could go ahead and buy back the contract. Again, simply a difference between the $56 I received minus the $40 I'd have to pay back to buy back those contracts. Again, a -8 there for the contracts I currently hold. Then I would essentially keep $16 after everything was completed. I'd no longer be obligated to sell AT&T for $33 a share. Same thing for a put sell here with Portola. You can see I have a -1 contract. I could buy that contract back, but now, as you can see here, the total return would be -$5. Again, I got $25 credit here, but to buy back that contract, it's currently at $30 or 30 cents per share. So I'd lose some money there. So I wouldn't want to do that at this point. And another thing to note on this one as well, this expires in 2 days. It's very unlikely that AT&T currently at a share price of $32.55 is going to get up above that number. So it's better for this particular contract to simply expire. I keep the $56 instead of trying to buy it back and making only $16. But either way, it's a positive trade, very, very low risk. Really the only downside would be that if AT&T did get up to $40, for example, I could only still sell it off for $33. But there's no risk of losing any money in this particular trade. The put sell, it's a little bit different because Portola here, in a very extreme example, could go all the way down to 0. I would still have to buy the stock even though it's not worth anything, so I could potentially lose all of that cash collateral. So the potential negatives for selling off a put contract would be that cash collateral. I could essentially lose all of that. Highly unlikely that would happen, but theoretically I could lose $3,500 on this trade. For this particular contract, I really can't lose any money other than some upside potential. If AT&T did get up to $40, I'd simply lose that potential gain of $7 per share because I would have to, again, sell it off for $33 a share. So I hope that makes sense. Just wanted to go through all of the contracts here in the portfolio. Again, I've been doing 2 or 3 of these contracts per week, and as you can see here up on top as well, I did some longer contracts, a little bit higher payment stocks that I'm going to hold in the portfolio. And if I have to sell these stocks off at the particular price, for example, Ford for $12, APLE for $20, or IRM for $35, more than happy to do that because I'll have a positive swing trade as well as keeping that cash collateral that was given to the portfolio for making the contracts. I hope that makes sense. I know these can get quite complicated, so if you guys have any questions about exactly what's going on, how I'm making extra income on the portfolio with these covered calls as well as cash covered puts, please let me know. It's a very good way of earning, again, extra income on stocks and on some unused capital in your portfolios in a very safe manner. Again, covered calls are better, a little bit safer than cash covered puts, but either way, I think they're very safe if you know what you're doing. So please let me know if there's any questions about that. And not to make the video too long, I'll kind of end it here. Again, all of the videos on the channel are inspired by questions that you guys have. So if you have any investing question, please let me know. If you guys have any good stocks that you're taking a look at for covered calls, for selling off cash covered puts, for doing any dividend capture, swing trading, please let me know. I'm always looking for new stocks to research and potentially add to the portfolio. So again, not to make the video too long, I'll kind of end it here. And again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. And until next video, we'll see you then.